Okay, class, good evening. So let's start our class for tonight on financial reporting. So tonight we're going to be starting a fresh topic, which is IAS 38 on intangible assets. So the trend of our class, of our classes, this would be the fourth standard. So we are moving at a very impressive pace, even though each topic is wide and requires a lot of time for you to fully have a good grasp of it. And we successfully finished IAS 16 in our normal class. And in the extra class, we were able to deduce, that is the class on Thursdays, we have been able to achieve two standards, IAS 23 and IAS 40. Very important, very practical standards. And I hope you're studying them and you're revising the questions you have solved on those standards. Today we are moving to another very dynamic standard, a very controversial standard, a very old standard that might be revised very soon. A lot of things has changed since this standard actually came out, especially in the technological space. A lot has changed. So we expect this standard might be updated. And this standard we are talking about is IAS 38, talking about intangible assets. So basically, we're going to look at accounting treatments for intangible assets, recognition, measurements, disclosures. So, which is basically what we look at in every standard, or what we're going to look at in every standard that we're going to be learning in this class. So the very first that we need to understand is what is an intangible asset. And this standard defined an intangible asset. It says is an identifiable non-monetary asset without physical substance. Identifiable non-monetary assets without physical substance. So, it defined it in like three phrases: identifiable, non-monetary assets without physical substance. So we need to break it down and look at them one by one. So the first element of this definition is that an intangible asset is an identifiable asset. And what that means is that it must be separable, or it must arise from legal or contractual rights. That is identifiable. It must be separable, or it must arise from legal or contractual rights. So if an intangible asset is separable, what does that mean? It simply means that intangible asset can be separated from the entity as a whole, which means that we can transfer, we can sell, we can rent out that intangible assets without having to sell or acquire the entire entity, right? So it's separate, it's separable. It's something we can actually sell out. It's something they can acquire from us without acquiring the entire entity. And typical examples of intangible assets that are separable are intangible assets like licenses or patents. These are intangible assets because they are separable. So when you have a license, whether you want to operate a bank and you got a license from CBN, or you want to operate a school and you got a license from Ministry of Education, or you want to operate an airline and you got a license from Ministry of Aviation, or you want to operate a radio station and they give you a license, whatever you get a license for, that license is something that you can actually sell, because that license is just a piece of document. Though without it, you can't operate, but you can sell it. That, okay, you go and use this license. All your other assets are still intact. Your buildings will still be intact. Your furniture will still be intact. But you can sell it without having to sell every other part of your business. Or maybe a patent. A patent is what you get from, I think, Ministry of Industry. When you have an invention and you don't want any other person to use that your invention without coming to see you first, so you patent it. So when you have a patent, that piece of document you get is an intangible asset, but you can sell it out. You can transfer it. It's something that is actually very separable and a lot more like that. Now, aside being separable, an intangible asset can also arise from legal or contractual rights. And I'll give you two scenarios for that. Number one is that in the consolidated accounts, good enough, you have been taught group account. In group account, you see, when a parent acquires, let's say, long-term contracts with major customers in the books of the subsidiary, he acquires a subsidiary, and that subsidiary has major contracts, let's say from government. So even though those major contracts might not show as an asset in the book of the subsidiary, but in the consolidated accounts, as far as the parents or the group is concerned, it's something that will generate money for the group in the future. So they put those contracts in their books as an intangible assets. Okay, that's because they are arising from legal or contractual rights. That's in the consolidated account. Not only that, if you have items like, let's say, you acquire a subsidiary and the subsidiary has like a good name or a brand name, in the consolidated accounts, you put it in the group accounts, brand, and you attach a value to it. So, and that's because you have acquired that subsidiary. So there are some intangible assets that exist or that are that you can identify because of they arise from legal or contracts. Or in the individual account of entities, for example, now, you can have assets like a franchise. A franchise is when let's say all these Apple store you see around, that you see around, like the original Apple outlets that you see in Nigeria, most of them, for them to be an reseller, most of them would have gotten a franchise from Apple. And Apple giving them that franchise would have been for free. They have given them franchise so that they can go and use that Apple's name in their local country. So that franchise, their ability to use that name Okay, to those companies that you see around selling Apple products using that logo as if it's an Apple extension, they have bought a franchise from Apple. That franchise they have, they cannot go ahead and sell it to another person. You bought a franchise. Apple have given you the authorization to use their name. You too, you now want to know. That franchise is not something they can transfer to another party. But it is an asset to them because it's arising from legal or contractual rights. It's like they have an agreement with Apple that, okay, you can use our name, and they will have paid for it. So intangible assets must be identifiable. And identifiable means that these assets are intangible assets. So we cannot them, we can identify them because they are separable. That's one. It's something we can sell, like license, like patent, like trademark. It's something we can sell. Or if you cannot sell it, it must have arise from legal or contractual rights, like a franchise in a company that has paid to use the name of a bigger company. They have paid, like the Apple example that I gave you. Or in the consolidated accounts, you find things like intangible assets that are measured at fair value, like long-term contracts, like brand names. You find it in the consolidated account. These are intangible assets that arise from legal or contractual rights. That is identifiable. So for us to say an item is an intangible asset, it must be identifiable. Secondly, an intangible asset is a non-monetary asset. And non-monetary means that is, is, is a non-financial asset. That's another name for that. But for me to properly explain non-monetary, I think we need to understand what is monetary. If we can understand what monetary is, then non-monetary will be the opposite. So, you see, when we say something is monetary, it means you are getting back a fixed amount of money. Monetary assets is any assets, any item where you're going to get a fixed amount back. You know how much you're getting back. Like the money you have in your bank account, for example, now, you know how much you're getting back. Like your long-term investments now, you know how much you're getting back. Like your trade receivables now, these are monetary assets. You know how much you're getting back. They are assets that you're going to get a fixed amount of money, or your loan receivable. These are monetary assets. You're getting back a fixed amount. So if you look at all these examples, trade receivables, loan receivables, bank accounts, long-term investments, these assets are assets that you cannot see or touch. So one would think that, why is it not an intangible asset? The reason is because they are monetary. So for the opposite of that is non-monetary. Non-monetary is that you are not expecting a fixed amount back. The amount you will get back is variable. So when you have an item where you are not sure of the benefit you will get, where you are not sure of how much you are expecting as benefit, that is a non-monetary asset. So an intangible asset must be a non-monetary asset. And finally is that an intangible asset must be without physical substance. It must be something that you cannot touch, you cannot see, and you find out that they are mostly technology-based items, at least in the world that we are today. So those examples I've been giving you, yes, those ones also are intangible assets like licenses, patents, franchise. But right now, most intangible assets you will find will be items like softwares, like apps. Those are like your database. Those will be intangible assets right now because they are mostly technological based. So that is the definition of an intangible asset. That is how the standard has chosen to define an intangible asset. Is an identifiable non-monetary asset without physical substance. Any questions on that? Okay, now look at this scenario. So this company, Entertain Co, entered into negotiations to acquire Gadget Work brands from Gadget Co for 1.2 million naira. This would give Entertain Co the ability to sell products under the Gadget Work brands and give access to Gadget Works web domain name. Okay, so this is similar to the example I gave you, that of Apple. Those resellers that you see around, it's just the same thing as this sentence here. That this company, Entertain Co, wants to start using the brand of Gadget Co. They want to start using their brand. And he paid, Entertain Co paid 1.2 million for that brand. So then I said Entertain Co did not wish to acquire any other assets of the Gadget Co business, such as other brands or properties. So therefore, I had no interest in acquiring Gadget Co business. Okay, so this example is just a scenario to you that as far as Entertain Co is concerned, he has a franchise. And that franchise is an intangible asset, which he paid 1.2 million for. It's an intangible asset. And of course, it's identifiable because it is arising from contracts. So it's identifiable. It is a non-monetary asset because Entertain Co cannot say, okay, for the fact that I have bought this brand from Gadget Co, this is the amount I will get back. He's not sure. He doesn't know. It depends on how well he can use that name. And of course, this brand or franchise that he has bought is without physical substance. So he meets the definition of an intangible asset. So Entertain Co will recognize it in his books as an intangible asset. Of course, before you can recognize any asset, it's not just about meeting definition. There are recognition criteria. And that's the next thing we need to look at, very importantly. Okay, now I can attend to questions before I move to the next item. Any questions? Now let's look at recognition criteria, recognition of an intangible asset. So all I'll just tell you is this. If you remember the recognition criteria for PPE, if you remember the recognition criteria for PPE, is exactly the same for intangible assets. And what's the recognition criteria for PPE? It is probable that future economic benefits attributable to the assets will flow to the entity. And number two, it must have a cost that can be measured reliably. It's the same. So if you remember that of PP, you can easily transfer that knowledge to intangible assets. It's the same for the two. Now, let's go to measurement. How do you measure an intangible asset? How do you get the value? Okay, this item have met the recognition criteria. How will I measure it? Now, speaking of measurement,
No.
yes. Yeah, go ahead, please.
That's so sorry about it.
Okay, can I go ahead? So let's go to measurement. So first, we'll look at initial measurement of cost. But because of the nature of intangible assets and the diversity of it, so we'll look at different scenarios, different ways in which an intangible asset can be originated, which will then drive how you measure them. And the very first and obvious one is a purchased intangible asset. Like you purchase a software or you purchased a like a franchise or you purchased a license. Those are purchased intangible assets, those that you can buy. So purchase intangible assets, the same way we measure PP is exactly the same way we measure them. They are initially measured at costs. The same thing, no difference. They are initially measured at cost. The second one, which is another way in which an intangible asset can be created, is an internally generated intangible assets. And from the name, internally generated, you should understand that these are intangible assets that we did not buy, but rather we developed them over time. We generated them over time. And a typical example is brand name or goodwill. That is the typical example of an internally generated intangible asset, or even your customer list. You know, your customer list is an intangible asset. Is internally generated. So you see, when you have internally generated intangible assets, they cannot be measured. In fact, they are not recognized in the books for the fact that we cannot, they don't meet the recognition criteria. You know, the recognition criteria is that future economic benefits that are associated with it must flow to the entity. So when you have goodwill now, what future economic benefit are we really expecting? It's difficult to establish the benefit. It's very difficult. We cannot say this is the amount of benefit we're expecting from goodwill. You cannot attach that, okay, out of the sales we have made this year, this is the one that relates to our goodwill, or this is the one that relates to the fact that we have a good name. Yes, we know it's adding to the revenue, but we cannot establish how much. We cannot reliably do that. So that's a major reason. And number two is that the costs that you incur to develop that name, that brand name, costs, we cannot establish it. So even if you want to put it in our books, how much? So we cannot. We cannot determine the benefits. The future economic benefit is not there. And the costs, we cannot estimate the costs reliably. So it doesn't meet the recognition criteria. And that is why we cannot put it in our books. And some people will find them arguing that training costs should be capitalized. Training costs should be capitalized. That should be, we will get benefit from it and all of that. I mean, you cannot capitalize such costs. It's similar to the reason I gave you for internally generated. That's why I'm bringing it up here. Training costs cannot be capitalized because you don't know the benefits you will get, because those staff can leave anytime. They can leave. I mean, at a very basic level, taking out unnecessary complexities. They can leave anytime. So you don't even have that, okay, this is what I'm expecting, this is the benefit that I will get. You don't have, basically, you don't have control. That benefit, you are not sure that it will flow to you. So internally generated intangible assets are prohibited from being recognized in the financial statements. So, I mean, these are things they are working on, because the fact remains that this goodwill, this brand name, they actually create benefits, no doubt about that. But the challenge for us accountants right now is that how do you determine that amount of benefit? How much have you spent to develop that brand name? How much? That's the challenge we are looking at solving right now. But at the moment, do not recognize it in the books. Another one is research and development. Is another way in which you can originate an intangible asset. We have talked about purchased intangible assets. We have talked about internally generated intangible assets. Now we are talking about research and development. Now, you see, this research and development is very similar to internally generated, because research and development relates to a scenario where we are developing an item in-house. But this one is different from brand name or goodwill. This one is we are working on a project. Like, let's say we are creating an app, or we are creating, let's say, a server. We are creating a technology, a piece of technology. We are creating an AI machine, something like that. So research and development. So this is like an internally generated asset that we can accumulate the costs and say, okay, this is what we have spent. Though they now even separated it into research cost and development cost. So there are two things entirely. And they say that the one that is research costs, the examiner will tell you that this one is research. The one that is research cost should be expensed. That one is not an intangible asset. Research cost is not an intangible asset. But development cost can be capitalized if it meets 6 criteria. Development cost can be capitalized if it meets 6 criteria. And those 6 criteria, I shorten it for you as PIRATE. That is probable economic benefits, intention to complete the project, resources available to complete the project, ability to use or sell the item, is technologically feasible, expenses on the project can be identified. I codified it for you this way because I can ask it a lot for 4 marks. That development cost, what's the criteria for capitalizing development costs? So it is not all development costs that are capitalized. It's only the one that meets the recognition criteria that we can capitalize. The one that does not meet this criteria will not be capitalized. So, must be able to generate benefits. We must be able to complete the project. We must even have the resources to complete it. It must be something that when it's completed, we can use or sell. And is the technology available to complete it? And the expenses, the money we are spending, can we collate them together? Like that. So usually, the way you will know that this criteria has been met, usually the way you would know is the examiner will tell you that this company, they have spent so much money on this project, but they have not gotten regulatory approval. You see, all those money they have spent would be expensed because at that point now, he's not sure that they will complete the project. Because if they don't get regulatory approval, they can't go ahead. Or they tell you that they have not gotten board approval. Even if they get board approval, that is the board of the company, and they don't get regulatory approval, you still cannot capitalize development costs. Because at that point, we are still not sure that it will come to life. So that means any costs they incur after those approvals, that is the one that you capitalize. After those approvals. Basically, those are the angles the examiner will look at when they are asking you questions on research and development. So please, these are very key areas when they want to ask you questions on intangible assets. You see them asking you around these three. So you really need to, these are very important, extremely important. Okay. Now, I've mentioned something
The
about,
last one.
yes, Oliver, go ahead, please.
I'm trying to get the last one. The last E. It said expense on the project can be
Identified.
identified. Okay. All right. Thank you, sir.
Yeah. Now, there is this one. There are some intangible assets that they are only recognized in the consolidated accounts, like brand names or research costs. It's only because they are ordinarily, they are not recognized based on the fact that most of them, the rules in IAS 38 says don't recognize them, like brand name, for example, now, because they are internally generated. But you find out that a parent or an entity can buy another company and it pays for the brand. As soon as it pays for the brand, that means you recognize. In fact, IFRS 3 says that internally generated intangible assets can be recognized in the consolidated account at fair value, as in the group account at fair value. So you should take note of those ones. And you should have done some of them in group account. So there are certain intangibles that you find out that they are only recognized in the consolidated financial statement. So it's controversial, seriously. That's of consistency. Because they will argue that since the parent has paid for it, since the parent has paid for it, so that means it's a purchased intangible asset. So controversial in the sense that, okay, so why can't an individual company also value that internally generated assets? Because how did the parent that pay for it get the value? Why can't individual companies also get their value and put it in their books? Because truth be told, companies like, there's nobody here that don't know GTMAP. If you go to their financial statements, that brand, that name is something. That name is adding value to that company, is bringing in benefit. But if you go to their financial statement, you will see that it is not, they don't have any brand name as part of their asset. Because IAS 38 says that we cannot measure it reliably. We don't know the benefits we will get from it. We don't know how much we incur to create it. So that means, if you look at it in totality, that means the assets of that bank is undervalued to a large extent. Now there's something that is making money that you're not putting in your books. Something is missing. So these are areas, maybe not for now, but there are areas we would debate in the nearest future, when most of you will have qualified, apparently. Now, speaking of research and development, there's this question I want us to look at. It says RESCO are developing a new line of pharmaceuticals, and they have spent 2 million up to 1st of January 2005. On 4 January 2005, board gave approval to fully fund the rest of the project following promising results. So that means all the money they spent, this 2 million up to these dates, will be expensed, because they only got board approval on 1st of January. So is any money that is spent after this date that we can consider? So they now said they spent a further 1 million to April. Okay, so on April, problems were discovered in the trials and approval was not given from the medical regulator. Okay. They have not even gotten approval from the regulators. So even this 1 million they spent before April will be expensed because they have not gotten regulatory approval. So RESCO spent further 1 million to July, at which point they got approval. So that means even this 1 million they spent to July will be expensed because they only got approval in July. So it is any money they spent after July that will be capitalized because they got regulatory approval in July. So from 1st of July to 1st of October, they now spent 1.5 million, putting the product into the final finished stage of development. So the new pharmaceuticals are expected to generate revenue in excess of 20 million and have a useful life of 5 years. I mean, this is what I'm talking about. In this scenario, every other expense will be categorized as research costs or development costs that will be expensed. The only one that will be capitalized is this 1.5 million, because it's the cost that was incurred after we got all approvals. And that's how you would know when a development cost has met all those criteria, those pirate criteria. That's the basis for knowing it. When we have gotten board approval, when we have gotten regulatory approval. So it is in this line you will see your exam being structured. So you need to take note of that. You need to take note of that. Okay. Latif.
Well done, sir.
Oh.
In this example you gave us, we have board approval, we have regulatory approval. What if in a question we only have board approval, no regulatory approval? So what should we consider?
So that means any cost incurred after board approval will be capitalized. So that means in that scenario, there's no need for regulatory approval.
Thank you,
For
sir.
the Any other question? Okay. Now, subsequent measurements. So the good news is that if you remember all the details, because I know I took a lot of time teaching you this under IAS 16. So I say similar to the principles in IAS 16. So it's the same thing that I taught you in IAS 16. It's the same thing here. So I'm not going to repeat anything here at all. So we use cost model and evaluation model. The same, all those things that I taught you. For cost model, I told you is cost minus accumulated depreciation. But here, they don't call it depreciation. They call it amortization. That's what they call it here. Minus accumulated impairment losses. The same thing here. For evaluation model too, fair value minus subsequent amortization, accumulated amortization, minus accumulated in all those principles I taught you in IAS 16, the same. Now, note the peculiarity here. Listen up. The peculiarity is this. For example, now, for cost model, you find out that most intangible assets would have an indefinite useful life. They will have an indefinite useful life. And similar to the way we don't depreciate land because we cannot estimate its useful life. Similar to that knowledge, we will not amortize such intangible assets. So for intangible assets with an indefinite life, there is no amortization. So what we usually do is that the company is required to perform an annual impairment review on that asset to assess whether the asset is impaired or not. So there is no amortization. All they do is just to do annual impairment review. This is a very important point. Very important point that every financial reporting student must understand perfectly. That intangible assets with an indefinite useful life are not amortized. But we do an annual impairment review on them. We do an annual impairment review. So I've not actually taught you impairments, but when I teach you impairment, I will explain to you that they are majorly determined by comparing the carrying amount of an asset with its recoverable amount. So we're going to talk extensively on that. Please note that. Secondly, for evaluation model, what is peculiar to intangible assets is that most intangible assets are never measured at evaluation model. Most of them. And I mean, I'm being realistic now. Most of them will be measured using cost model. And the reason is that for you to use evaluation model for intangible assets must have an active market where you can get the fair value. Because that's the whole essence of evaluation model. Before you can use evaluation model for an intangible asset, there must be an active market for that intangible asset where you can get the fair value. And the reality is that most intangible assets are just on their own. They don't have any activity. Is it license that you want to be looking for active market for, or franchise, or software that you develop in-house? Or is it your database, or what? Name it. So you'll find out that before, I mean, that's a principle that accountants have to learn, and you guys are listening to it right now, that before you can use the valuation model for an intangible asset, it's expected that that intangible asset must have an active market where you can get the selling price of that intangible asset or its fair value. Otherwise, just use cost model. So those are the peculiarity for subsequent measurement that you really have to learn, that you seriously have to put into consideration. Disclosure requirements. So for an intangible asset, it has the same disclosure requirement as that of PP, the same. The peculiarity or additions are, we need to disclose whether the useful life of the intangible asset is finite or indefinite. So if the useful life is finite, we need to state what is the useful life, or what's the amortization rate. If the useful life is indefinite, so we need to state how did we assess that it has an indefinite useful life. And you need to also tell us the amount of research and development expenditure that has been written off as expense in our books. That also has to be disclosed. So there are past questions here. I will solve one, and I want you to solve this one yourself without looking at the solution first. You know, I know that I gave you an assignment on PP, those practice questions. Unfortunately, nobody has done it, and that is not good at all. That is very scary. That's very scary, because that is not a good start. All these IAS standard I'm teaching you is they are principle based. There are a lot of principles that I will actually talk about, but you really have to practice those questions that I ask you to practice. They are very important. So I've given you one assignment at PP. None of you did it. You have to go and do it and send it to me, except if you have looked at it and look at the solution and you understood it. I'm giving you another one here. Why I'm asking you to do it, because it's very similar. This is a past question, and it's very hard to those to those questions that we solved under PP. It's the same thing, not even similar, the same. So I just want to try it and see if you would be able to put your hands on it. But we'll find out. But let's look at this one. This particular one, I want us to look at this one, because there's some things I want to point out to you here. That this my answer can be different. It's not in stone for this particular one. So they say that an intangible asset by their nature do not exist physically under IAS 38. The following information on initial cost of intangible assets were extracted from the notes to the financial statement of Igbo Limited, a film production, on January 1st, 2017. So one useful thing about this question is that it gives you a lot of intangible assets, a lot of examples, books and literary works, quick books. This is like that accounting software. patents, video and motion films, franchise, pictures and photographs, order, a customer order or production backlog, place. We have customers' contracts, trademarks for customers, broadcasting rights, internet, trade secrets. I mean, these are a lot of examples. So they now gave us some additional information when they bought some of these intangible assets and their useful life. We're now asked to, they say intangible assets are amortized on a straight line basis. So when I say required, calculate the cost of the following intangible assets: market-based, customer-related, artistic-related, contract-based, and technology-based. So the challenge with this question that diet is the standard didn't categorize intangible assets based on any criteria. So the question is now asking students to calculate the cost based on market-based and all that. So I've grouped them together here. That's what I want to show you. Like for the market-based now, I put trademark there. Another person can look at it and say market, that no, QuickBooks should be market-based. I mean, I can't give those students full marks that diet because it's very subjective. There's no way we can say this. Or customer related. So which one can we categorize there as customer related? I mean, I can put customers contract as customer related. I can put order or production backlog as customer related. But what I put here are those two, yeah, as customer related. Then I put their cost that they gave me there to get their total cost. The same thing for artistic related. So those ones I put books and literary works, videos and motion films, pictures, plays as artistic. Then the one that are contract based, I put franchise and broadcasting rights. Other people might have even put customer contract and contract based. So, and technology, I put QuickBooks, patents, trade secrets, internet under technology. So like that. So majorly subjective. Then the question, another one also asks us to calculate the carrying amount. So that, okay, after determining the cost above, get the carrying amount. And you know that carrying amount is cost minus accumulated amortization in the case of intangible assets. So for the books, for example, now, since we have already determined the cost up there, the cost of the QuickBooks as 950, right? So the accumulated amortization would be, we will get the depreciation or amortization per annum first, because they give us the useful life of the QuickBooks here as 5 years, right? And we bought it 2016. And considering the fact that this is 2017, that means we bought it 2 years ago. If we bought it January 1st, 2016, so we bought it 2 years
A year
ago.
ago.
So we bought it 2 years ago. So the accumulated amortization will be the cost divided by the useful life. That will give us the amortization per annum multiplied by the years over which we have charged the amortization, which is 2 years. That gave 380. When you remove that from the 950, we have 570. I mean, the same approach for the trademark. Given the cost above as 4,600, the accumulated amortization is 4,600 divided by the useful life multiplied by the total years in which you have charged that amortization. And look at it straight. They gave us the useful life as 8 years. And since we bought it January 1st, 2015, and this is ending of 2017, so 3 years ago was when we bought it. So 15, 16, 17, 3 years. And that's why you see me dividing it by 8 to get the annual amortization and multiplying it by 3 years. And the same thing applies to the plays as well. So the useful life is 4,002 and we bought it 4 years ago. The same thing applies to the franchise. The useful life is 8 years, and we bought it 5 years ago, like that, to give us the accumulated amortization, which we are going to remove from the costs so as to get our carrying amount. So these are the things that I would have expected you to have practiced under PP and be used to them right now. So besides that, this question also asks us to identify 4 internally generated intangible assets that are prohibited in IAS 38. 4 internally generated intangible assets that are prohibited. So you remember that I told you that there are some internally generated intangible assets are prohibited from being recognized in the books. So in this question is now asking you for examples. And what are the examples? I think we give examples of goodwill and patents. And from this
Trade
question
secret.
now, what's it?
I said trade secrets can fall into that too.
Yes, we have trade secrets. Which other one can we bring in?
Customer contracts. No. I thought it was contact, not contract. Yeah,
Maybe customer lists.
yeah, customer list. Yeah. Oh,
Customer
there's no
list.
customer list there.
Yeah. So those ones, and those are what they actually mentioned here. Internally generated. We have, where is it? We have goodwill. We have brand names. We have mastheads. We have publishing titles. We have customer lists. We have trade secrets. All of that are internally generated intangible assets. Okay, so that is all for this standard. So there are few things that are just very new that we just discussed today. Very few things. Number one is that definition. You need to, I took time on analyzing that definition, especially that one that says identifiable, meaning it must be separable. I mean, it must arise from legal or contractual rights, that one. And also, I introduced non-monetary assets, where I explain monetary first, that they are assets where you get a fixed amount back, that any other one is non-monetary. So that took care of that definition. Then going into the recognition, I told you it's the same, no difference with PPE. Then went on to measurement. For measurement, the new thing was internally generated intangible assets. And we learned there that internally generated intangible assets are prohibited because we cannot measure the benefits and the costs reliably. So they are prohibited from being entered in our books. Then we learned about research and development, which is a new one, that research costs will be expensed, but development costs can be capitalized if it meets those pirate criteria. And I shorten them as pirates, just for you to be able to remember those 6. Then finally, we talked about subsequent measurements. And I said, yeah, it's the same thing as PP, cost model and evaluation model. But for cost model in intangible assets, when we have an intangible asset with an indefinite useful life, you do not amortize them. But what we do to them is to assess them for annual impairment review. Not only that, when you have evaluation model, before you can use the evaluation model for an intangible asset, you must have an active market where you can get the fair value. Other than that, it should be measured at cost model. So those are just things you need to note.